Hello! Today we are going to be comparing two different methods used to account for bad debts, the direct write-off method and the allowance method. The main difference between the two methods is in the timing of the recording of bad debt expense. When using the direct write-off method, bad debt expense is recognized in the future period when the company determines that they will be unable to collect an account. When using the allowance method, bad debt expense is estimated as an adjusting entry in the same period as the sale that created the account. There are both advantages and disadvantages for each method of dealing with bad debts. For the allowance method, one advantage is that bad debts are recognized in the same period as the sale they are related to, because that's when the estimate is made. This satisfies the matching principle, which states that expenses should be reported in the same period as the revenues that they help generate. The second advantage is a more accurate reporting of accounts receivable. Remember that allowance for doubtful accounts is a contra asset tied to accounts receivable. Therefore, when we estimate bad debts using the allowance method, we can find a more accurate estimate of what the company will actually collect, called the net realizable value of accounts receivable, found by taking the accounts receivable balance and subtracting the allowance for doubtful accounts. The main disadvantage of the allowance method is that the company needs to estimate the allowance for doubtful accounts, including deciding which method of estimation is appropriate, which can take extra time and work. For the direct write-off method, the main advantage is that no estimation of bad debts is needed. This makes accounting much more simple. Bad debt expense will be recorded only when an account is determined to be uncollectible. The disadvantages of the write-off method are that receivables and income will be temporarily overstated in the period of a sale that will ultimately be written off in a future period. Receivables are overstated because we can no longer calculate the net realizable value of accounts receivable if the allowance is not estimated. Income will be temporarily overstated due to the second disadvantage of the direct write-off method, that bad debt expense is not matched with sales, violating the matching principle. Bad debts should be reported in the period of the sale, but under the direct write-off method, we wait until the account is determined to be uncollectible, which can be several periods in the future. Since we are delaying an expense, income will be slightly overstated in the earlier period and slightly understated in the later period when the bad debt is written off. Again, this only applies to a period in which a sale is made that will ultimately be written off in a future period. So you might be wondering, if the direct write-off method violates the matching principle, how can a company get away with it? The answer is the materiality constraint, which states that an accounting standard can be ignored if doing so has little impact on reported information. This means if a company experiences relatively few bad debts, a small violation of the matching principle might be okay, and the direct write-off method could make more sense. Whereas if the company has a lot of bad debts, they should probably use the allowance method. So this problem asks us to prepare the journal entries for both the direct write-off method and the allowance method for Ellison Enterprises. So we'll start by looking at the direct write-off method, and then we'll move to the allowance method. So part 1 says that the company estimates, based on a percentage of sales, that bad debts will increase by $500 based on transactions in 2020. And it also says this is for the allowance method only. And that's because, as you might recall, when we use the direct write-off method, there is no estimation of bad debt expense, so we don't need to make a journal entry. So here we can type in no entry required. Next, on May 4, 2021, Ellison Enterprises determines that $2,000 of its accounts receivable related to Brian's Bagels Company will ultimately be uncollectible. So this is the next year, 2021, and we're not going to be able to collect $2,000. So under the direct write-off method, when we actually write off an account, which is what we're doing here, we use the bad debt expense account. And that will be for the $2,000 that we're writing off. And then, of course, we have to decrease our accounts receivable balance. So we'll use accounts receivable, Brian's Bagels, and that will also be for $2,000. Next, number 3 says that on October 15, 2021, Brian's Bagels unexpectedly pays the $2,000 accounts receivable balance that had previously been written off as uncollectible. So when a customer unexpectedly pays an account that you have previously written off under the direct write-off method, you're going to have two different journal entries. The first one is going to be to reinstate your accounts receivable balance, and that's just going to be the opposite of the writing off of a specific uncollectible account. So instead of crediting the accounts receivable for Brian's Bagels, we are going to debit. So accounts receivable, Brian's Bagels, will be a debit for $2,000. and then we will have to credit the bad debt expense, also for $2,000. And then the next journal entry is going to be for the actual payment. So this is going to be the cash that we're going to get, which is $2,000. And then we're going to have to decrease the accounts receivable, Brian's Bagels, also for $2,000. Now you might be wondering, why do we have to have two journal entries here instead of just one? Couldn't we have a journal entry with a debit to cash and a credit to bad debt expense? Since the accounts receivable is really offsetting itself, right? It has 2,000 debit here and then a 2,000 credit here. So why involve accounts receivable at all? And the reason is, well, we want to have a record of the accounts receivable being reinstated and then eventually paid off, right? If we don't do that, then it still looks like the accounts receivable was written off and then never paid. So we need to update that, and that's what we do in these two different entries. Alright, I want to talk a little bit about these journal entries that we've just recorded. I know nowhere in the problem did it tell us exactly when the sale to Brian's Bagels was, but if the sale was not in 2021, then we have just violated the matching principle by reporting this expense in a different period than the sale. Now, of course, it didn't matter too much in this situation since Brian's Bagels eventually ended up paying us down here on October 15th, but of course that's not going to happen in most circumstances. So now we can do the journal entries related to the allowance method. So part 1 says that the company estimates, based on a percentage of sales, that bad debts will increase by $500 based on transactions in 2020. And since this is an adjusting entry, it's going to be on the last day of the period, which is going to be 12/31/2020. And what we're going to do, since we're estimating the bad debts, we're going to use the account bad debt expense for the $500 that they estimated, and then we use the allowance for doubtful accounts to offset the debit, also for $500. Next, number 2 says that on May 4, 2021, Ellison Enterprises determines that $2,000 of its accounts receivable related to Brian's Bagels Company will ultimately be uncollectible. So now, when the company determines that an account is uncollectible, we're not going to use bad debt expense. Instead, we're going to be using the allowance for doubtful accounts. So we have the same date, and we're going to use allowance for doubtful accounts for the $2,000. And then, of course, we still need to decrease the balance of accounts receivable related to Brian's Bagels, so we can credit that for $2,000. Finally, number 3 says that on October 15, 2021, Brian's Bagels unexpectedly pays the $2,000 accounts receivable balance that had previously been written off as uncollectible. So this is going to be very similar to the last entry that we did in the direct write-off method. We're going to have the same dates here, and we're still going to be reversing the previous entry. So now we're going to look at this entry, and we're just going to do the opposite. So we're going to be reinstating the accounts receivable by debiting it for Brian's Bagels for $2,000. And we need to reverse the allowance for doubtful accounts, also for $2,000. And the final entry is going to actually look identical. So we're still going to use cash since we are getting that from the company now. And we are closing out the balance for accounts receivable related to Brian's Bagels. So let's talk about these journal entries briefly. We see that when we use the allowance method, we report the bad debt expense as an adjusting entry at the end of the period. And that way the expense is reported in the same period as the sales, which is 2020 in this case. And when we write off a specific account, we use the allowance for doubtful accounts instead of the bad debt expense. Alright, we are finished with the journal entries. Now you might be wondering, which method should I be using? And that's going to depend on how material the amount of bad debt expense is. So if this company is reporting $2,000 of bad debt expense in a year, and maybe, let's say, every year they're reporting around $2,000 of bad debt expense. Well, maybe that's a very small amount relative to the millions and millions in dollars of sales that this company might be doing. So if that was the case, then it might make more sense to use the direct write-off method, since the amount of bad debt expense is immaterial. Whereas if this was a smaller company that maybe only had $20,000 or $30,000 of sales, and they had $2,000 of bad debt expense, that's a very large portion of their sales. So then it might make more sense to use the allowance method.